Hey everyone, welcome back to the channel. If you're serious about building wealth through the stock market, you're in the right place. In today's video, we're diving deep into 15 powerful rules that will help you find the best stocks for long-term investing, specifically if you live in the United States or invest in the US stock market. These aren't random tips. These are time-tested principles that legendary investors like Warren Buffett, Peter Lynch, and Charlie Munger swear by. And I've simplified them for you, whether you're just starting or looking to level up your investing game. Rule number 1, invest in what you understand. This is straight from Warren Buffett's playbook. Never invest in a business you don't understand. Ask yourself, can I explain in one sentence what this company does, who its customers are, how it makes money? If the answer is no, skip it. You don't need to be a genius to invest, but you do need to be confident in your understanding. Whether it's tech, retail, finance, or healthcare, stick to your circle of competence. Many investors lose money chasing hot stocks in industries they don't grasp. Don't fall into that trap. Rule number 2, look for companies with a durable moat. A moat is what protects a business from its competitors. It could be brand power, like Coca-Cola, network effect, like Meta or Visa, or high switching costs. Think Adobe or Microsoft. The stronger the moat, the more likely the company can defend its profits and market share over time. That usually means more consistent earnings and higher stock prices in the long run. Mini test. Ask, what would it take for a new company to destroy this business? If the answer is a lot, then you may have a moat stock on your hands. Rule number 3, strong and consistent earnings growth. Next, focus on companies that consistently grow their earnings, not just revenue. Earnings growth shows the business is not only selling more, but also becoming more profitable. That's what drives stock prices up. Look at the past 5 to 10 years. Is there a trend of steady growth in net income or EPS, earnings per share? Avoid stocks with wild swings or frequent losses, unless you're deep into speculative plays. Pro tip, use free platforms like Yahoo Finance or Morningstar to check historical earnings data quickly. All right, those were your first 3 foundational rules. 1, understand the business. Find a durable moat. 3, look for strong earnings growth. Simple? Yes. Powerful? Absolutely. Now let's dive into rules 4 to 7, where we focus more on the financials and fundamentals most new investors overlook, but pros never ignore. Rule number 4, strong return on equity, ROE. Return on equity tells you how well a company uses shareholders' money to generate profits. Think of it like this. How efficient is this business at turning investment into income? A good ROE is typically above 15%. Great companies like Apple and Visa consistently deliver high ROE. Why it matters? Because consistent high ROE often means strong leadership and smart capital allocation. Rule number 5, low or manageable debt levels. Debt can destroy companies, especially in a downturn. If a company's debt is too high compared to its earnings, interest payments can eat up profits fast. Look at the debt to equity ratio. A number under 1 is generally considered safe, but this depends on the industry. For example, utilities tend to have more debt than tech firms. Also check if the company can easily pay interest. The interest coverage ratio should ideally be 5 or more. Rule number 6, positive free cash flow, FCF. This is the real money left after all expenses, including capital investments. In simple terms, how much cash does the business actually keep? Many unprofitable companies show high revenue but negative cash flow. That's dangerous. Positive and growing free cash flow shows a company is healthy and can reinvest, pay dividends, or reduce debt. All good signs for investors. Quick tip, use sites like macrotrends.net to view long-term free cash flow trends. Rule number 7, consistent dividend growth. Optional but powerful. Not every great stock pays dividends, but those that do and raise them consistently are often very stable and shareholder friendly. Look for companies that have grown dividends for 10 plus years. Think Procter & Gamble, Johnson & Johnson, or Coca-Cola. These are called dividend aristocrats. Rising dividends often reflect strong cash flows and management confidence. Plus, you get paid while the stock grows. To recap, here are rules 4 to 7. 4, high return on equity. 5, low debt. 6, positive free cash flow. 7, consistent dividend growth. These are numbers you must check before buying any stock. So far, we've covered financial health, profitability, and business understanding. But numbers aren't everything. Now let's move to the qualitative side. Things like management, industry, and market potential. These next 4 rules, rules 8 through 11, focus on the people behind the company and the market they operate in. Let's jump in. Rule number 8, strong and transparent management. A great business can still fail under poor leadership, so you want to invest in companies run by competent, honest, and shareholder-focused management. Check earnings call transcripts, CEO interviews, or shareholder letters. Are they clear? Do they admit mistakes? Or do they just spin everything as positive? Look into their track record. Have they grown the company? Were there scandals or excessive compensation? Red flags, frequent leadership changes, shady accounting, or constant stock dilution. Rule number 9, industry tailwinds. Tailwinds mean the industry is naturally growing and lifting businesses within it. For example, cloud computing, cybersecurity, AI, green energy, these sectors are growing rapidly. A rising tide lifts all boats. Investing in a great company in a declining industry can be like swimming against the current. Bonus tip, read industry reports and macroeconomic trends. It helps you spot where the world is heading. Rule number 10, large and expanding market, TAM. TAM equals total addressable market. It answers how big is the market this company can serve. You want companies with room to grow, like Shopify did in e-commerce or Tesla in EVs. Even the best company can hit a wall if the market is too small or saturated. Check if the business is expanding into new verticals or geographies. That's a sign of long-term scalability. Rule 11, clear competitive advantage, differentiation. Why this company over its competitors? Look for something unique. It could be brand, technology, pricing power, patents, or even user experience. Think of how Apple combines ecosystem plus design, or how Amazon dominates with logistics. This is often the deciding factor between a good investment and a legendary one. That wraps up rules 8 to 11. 8, strong leadership. 9, industry tailwinds. Big market size. 1, clear advantage over competitors. These rules help you go beyond the balance sheet and understand the quality of the business. So far, we've covered how to understand a company, read the numbers, assess leadership, and check market potential. Now it's time to talk about valuation, timing, and mindset, the last 4 rules that truly separate smart investors from the rest. Rule number 12, don't overpay. Valuation matters. A great company can still be a terrible investment if you overpay for it. Stock prices can get ahead of fundamentals during hype cycles. That's where many retail investors lose money. Use valuation tools like the PE ratio, PEG ratio, and price to free cash flow. Compare them with the company's history and its peers. PE over 30? That's okay if it's a fast-growing tech company, but not for a utility stock. Also look at PEG ratio, PE divided by growth rate. A PEG under 1 usually means it's undervalued relative to its growth. Rule number 13, buy during uncertainty, not euphoria. The best time to buy is often when people are scared. In market corrections or downturns, great companies go on sale. That's when you strike. Be greedy when others are fearful, and fearful when others are greedy. Sound familiar? Yep, Buffett again. But never confuse cheap price with good value. Make sure the fundamentals are still strong. Avoid buying during hype rallies, IPO frenzies, or when the media says this stock can only go up. Spoiler, it can't. Rule number 14, think long term, 5 to 10 plus years. Time in the market beats timing the market. Every single time. Great companies take years to show their full potential. If you're jumping in and out every few weeks, you're not investing, you're gambling. Look at Amazon, Nvidia, or Apple. Their biggest gains happened after years of volatility and slow growth. If your thesis is strong, give it time to play out. Let compounding do its magic. Rule number 15, have a process, not just luck. Here's the real secret. Great investors follow a repeatable process. They don't rely on gut feeling or tips from TikTok. Use a checklist, maybe even these 15 rules, every time you research a stock. Test your thesis. Look at past data. Ask, would I still buy this if the stock dropped 30% tomorrow? If yes, you're investing with conviction. Build your own framework. That's how confidence and profits are built over time. And there you have it, 15 rules to find the best stocks for investing in the US market. Let's quickly recap all of them. 15 rules recap. 1, understand the business. 2, look for a moat. 3, strong earnings growth. 4, high return on equity. 5, low manageable debt. 6, positive free cash flow. 7, dividend growth, optional. 8, strong management. 9, industry tailwinds. Expanding market size. 1, competitive edge. 1, 2, don't overpay. 3, buy during fear. 4, think long term. Follow a process. These rules won't guarantee profits overnight, but they'll help you avoid big mistakes, stay disciplined, and build real wealth over time.